Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is open up any equities underlying in your brokerage platform, and you want to simply navigate to see the list of expirations for that underlying, and we want to lock in on an expiration date at this point. The expiration date that we want to choose needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly expiration date. Now, it doesn't matter what underlying you do this on, all equities underlyings have the same expiration dates. So, in order to choose an expiration date, we need to be between 30 and 60 days out in time. And the only expiration date that fits that criteria is January 17th, with it being a monthly expiration. So we can take this information 46 days, come over to our watch list, and we can simply filter out any and all underlyings that have earnings over the next 46 days. And what that's going to do is that's going to allow us to bypass taking on additional volatility risk as we get closer to earnings. Earnings will also mess up our deltas almost certainly. So it allows us to avoid these things, and it will overall will have a smoother P&L curve by taking this step. And we also want to remove any underlyings that have a low liquidity rating level. And what we'll be left with is something that looks like this. This is just a pre-made watch list. You can use any watch list that you'd like. And I like to order everything from high to low IVR. We want to be selling contracts when volatility is high and then playing the contraction back down to the mean and potentially even further below. And we want to try and find underlyings with an IV rank of over 50. Over 50 can be considered high, below 50 can be considered low. And that's simply it. And we also need to keep in mind, what's also already in our portfolios. The reason for this is because we do not want to be too heavy in any one sector or industry. You want to keep things nice and diverse to protect you from any significant moves in the market in any industry or anything like that. So we just go down the list, and straight away EWW with an IV rank of 48.5. It's slightly below 50. However, it is also an ETF, so you don't take on the company risk with ETFs. So EWW is looking quite nice. It's trading at just under $50, an IV rank of 48.5, and an absolute IV level of just under 29%. So if we have a look at EWW, we know that we're going to be at the January 17th expiration date, and we can pull up the list of expirations here for EWW. Now, at this point, we simply want to sell one call and one put. For whatever reason, this doesn't seem to be loading properly. Bear with me. So we're not going to go with EWW. It seems to be tripping out. I don't know what's going on with EWW. There's no volume at all on EWW, so we're just going to stay away from that. And we're just going to go down to the next underlying, which is Tesla, currently at an IV rank of 41, which isn't the best, but it's not the worst either. It has an absolute IV level of 57%. It's currently trading at just under $353. So let's have a look at the January 17th expiration. And this is the options chain. This is how it should be looking. And we want to sell a call contract and a put contract, and we want to sell them anywhere between a 15 and 20 delta. So we can go with the, say, 21 delta here at the 430 strike, and then on the put side, we've got a 21 delta at the 310 strike. And this gives us a nice range between 310 and 430. As you can see, this orange bar is the expected move, and this green bar shows us where our break-even points are. So as we can see, the green bar is far bigger than the orange bar. It overshadows the orange bar. This is going to lead to a high probability of success. As we can see here in the bottom left corner, we've got a 67% probability of profit, and then between 80 and 85% probability of hitting 50% of max profit at some point over the next 46 days. So very, very, very high probabilities. We'll get $43 of daily theta decay. We'll collect just under 1.7k in premium upfront, and our broker is going to require a little over $14,000 in buying power to open this position. Now, $14,000 is more than what you probably want to allocate. So what you can do is simply buy a contract a little bit further out on either side. And what this is going to do is it's going to limit our max loss. It's no longer going to be undefined. It's now defined to the difference between the strikes minus the premium that we collect. So our max loss is $320, and that's the amount of buying power that we're going to require. So it's no longer $14,000. It's only $317. We will collect less premium up front, but we now have a much higher return on capital. And in exchange for this trade-off, we have a slightly lower probability of success. So, however, this is still a completely valid trade. So that's how you can find positions and manipulate positions to fit inside your portfolio. If you want to know how much buying power you should be allocating to your positions, click the link in the description. Click on free position sizing template, and it will take you to this. The way it works is you enter in the size of your portfolio at the top, and then the current VIX level below. Everything will then be calculated for you. All you need to do is use this information to form the backbone of your portfolio, and you'll be absolutely fine over the long term. If you want to learn in more detail, click the link in the description. This time, click on EDS Premium, and then get yourselves signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time, so that you can copy or use as inspiration. There's also a full course inside, so no prior knowledge is required at all. We will teach you everything that you need to know from start to finish. It is also a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's also a 100% money back guarantee. So if at any point after 6 months, once you study the full course, follow our trades, if you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's risk-free on your part. Right now, it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.